Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim. Good to be back.
What happens to the U.S. economy if there's no new stimulus until after the election?
That'll be bad. For the past few years, the Federal Reserve and the stock market have been playing this game in the U.S. where the Fed tries to tighten or at least stop easing because it doesn't want to, keep increasing ease and keep cutting interest rates forever. And then the stock market behaves like a drug addict cut off from its drug supply and just starts to collapse. And then the Fed caves and comes back with lower interest rates and more quantitative easing, et cetera, et cetera. And so we're back there to that now, where the Fed has promised low interest rates basically forever, but not an increase of ease. In other words, they're promising stability of low interest rates going forward, which means the federal government has to be the one to add the increasing amount of heroin to the economy's bloodstream. And right now what's happening is because we've got gridlock between the Republicans and Democrats over the next stimulus plan, the new supply of easy money has been temporarily cut off. And that makes the stock market really dangerous right now. It's still assuming a new stimulus deal in the short run, but the sounds coming out of Washington are less optimistic. It's like there are political reasons for both sides not being willing to bend going into the election. So it's possible that it dawns on the market that there's no new stimulus coming until after, a transition to new leadership in January or something like that. And the stock market reacts badly to that. So that's the thing to watch out for right now. If you're a active investor, shorting has become a higher probability bet because the risk of the market flaking out over not getting the stimulus that it thinks it's getting is pretty high right now. And, if that happens, the stock market could tank 20 or 30% in the U.S. easily. We've done that either 2 or 3 times in the last 3 years, where you just have this flash crash. And all of a sudden you go from all-time highs to a new bear market, 20% down from the peak, in, the blink of an eye, just a few weeks. So we could easily have that again, which would prompt the government to ease like crazy again. So, we're not done with that game. We're just in the part of the game where, the stock market calls the Fed's bluff and forces more ease.
We're hearing noises about negative interest rates. Why would they do that? It hasn't worked in Japan or Europe.
Well, it hasn't not worked in Japan and Europe. I mean, those economies still exist, right? And they're still functioning, even with negative interest rates. So it's something that that the Fed can do to make it look like it's doing something, even if they don't have any functional advantage for an economy, negative interest rates. At least it looks like the central bank is taking steps to fix whatever problem it's addressing. And, at this point, that's all the markets really care about. They want to believe that there's adult supervision. And somebody bigger and more powerful than them is going to ride to the rescue. So there's no reason to think that our economy won't go to negative interest rates in the next crisis, just because that's one of the few things they have left to do. There's not really much left. We're already running deficits in the U.S. at 10% of GDP, which is an insanely high number. That would have been unheard of and inconceivable 5 years ago. Even back during the the peak of the big deficit spending period right after the Great Recession, 2008, 2009, 2010. 10% of GDP was a massive number, and now we're doing that kind of casually. So they're really, the idea of going from 10% to 20% is even more inconceivable than going to 10%. So there isn't a lot left for us to do, and negative interest rates might just be one of the things we do because we can.
What would that do to pension funds, banks, and insurance companies that rely on some kind of a return?
Oh, it would crush them, because anybody who's running a portfolio that has a fixed income component in a negative interest rate environment, that fixed income portfolio generates negative returns. In other words, it gets smaller year after year after year. And if you're a pension fund, for instance, that has obligations out in the future that are quantifiable, you know how much it's going to cost to take care of your baby boomer retirees. So you know how much money you need. Well, part of investing to achieve that amount of money is having a positive return from your fixed income portfolio. So if that goes away and becomes a negative thing, then you're completely reliant on high risk assets like stocks and other alternative investments and maybe even derivatives. And that changes the nature of your portfolio. All of a sudden, you're not a low risk investor anymore. You're a hedge fund who's taking massive chances in order to achieve the goal that you've set for yourself. And we don't want our pension funds to become that, because they will blow up eventually. Next time there's a big bear market in stocks, which there will be someday, or next time there's a blow up in the derivatives market or real estate tanks or whatever, the pension funds need a big fixed income portfolio to protect them from the 10, 20, 30% loss they're going to see in those other portfolios. So if their fixed income portfolio is dropping in value and these other things blow up and the pension fund is already wildly underfunded, like a lot of ours are, then they just fail. So you would have failures across the financial sector in an extended negative interest rate environment, at least in the U.S. And that'll be the downside. We'll do negative interest rates. The markets will kind of like it to begin with, and then the reality will set in, and the financial system will start to deteriorate to the point where it blows up unless something else happens. So that's in our future. I would give that whole scenario a 70% probability right now.
We'll have more with John Rubino right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with John Rubino. John, if stocks tank, will they pull gold and silver down too?
Yes. They do that every time. In the, the cycles that I was talking about before, where the Fed tries to tighten, stocks tank, and then the Fed caves and starts easing again. When stocks tank, they pull down precious metals too, for a counterintuitive but also pretty good reason, which is that when one set of investments are collapsing, you generally want to try to raise cash, right? And you raise cash from the stuff that's not collapsing. So you turn to your precious metals and you sell them too. So they get thrown out with the bathwater in this kind of a situation. And that has happened over and over again. It happened big time in 2008 when gold and silver just tanked along with stocks. And then it happened again in March of this year when stocks fell pretty hard and gold and silver fell as hard or harder, and the gold and silver mining stocks just got crushed. I have a big portfolio of mining stocks. And you know what? I wish I'd mortgaged my house and or sold a couple of my kids or whatever and bought more gold and silver miners when those things tanked, because they since just rocketed upward. But I think a repeat of that is certainly possible, if not probable, going forward. That's because in bull markets you always have corrections, and gold and silver in a bull markets, so we will see corrections, and stocks are wildly overvalued, so we should see a more than a correction in equities. And so you combine those two things. Gold and silver are due for a correction, and stocks are tanking, and that could really knock gold and silver down. I don't necessarily think that happens next week, but I think that's a risk out there for precious metals investors. Although for, most people who are buying physical precious metals, you should see that as a good thing, because it just means that this month you get to buy gold and silver cheaper than you did last month. So don't worry about it, because the ultimate end point for gold and silver in this kind of an environment are much, much higher than they are today. I would say start easing out of your riskier gold investments at $5,000 an ounce US, and then be mostly out at $10,000. So, you got plenty of time to watch these markets go up and down and up and down with an upward bias before you really have to start thinking about moving out of those things as they become possibly overvalued and into whatever's super cheap in the moment. But right now, this is one of those buy the dip kinds of markets in precious metals, where if it goes down, buy more. Don't worry, because the overall trend is up.
If governments are forced to stimulate from here, what can they do?
Well, yeah, see, that's the question they're asking themselves. We're going to run massive deficits in the U.S. for sure. Central banks are starting to say, as you mentioned before, negative interest rates have turned out to have limited utility. They just don't seem to do that much for an economy. And central banks are telling their governments that and lobbying for more stimulus from the governments themselves. In other words, fiscal stimulus. So that's what we'll see going forward. You can run, in theory, unlimited deficits, right? You could run a deficit that's bigger than GDP if you want to try it. I mean, mathematically it's possible, but there's probably a limit to how much market participants will accept from a government that's borrowing insane amounts of money. But because it's theoretically possible to run bigger deficits than today's, we will try that, because the system wants to collapse. And governments are leaning against that collapse with all kinds of crazy monetary and fiscal experimentation. But they can't let the collapse happen, because they will get blamed for it. The people in charge will get blamed for the next Great Depression, or whatever we're going to call it, if it happens on their watch. So they will do whatever they can to prevent it. And right now, they've still got fiscal stimulus as a possibility, and they've still got negative interest rates. Those two things will be proven to be ineffective at some point in the future, but for the time being, that's what we'll try. So yeah, we'll see bigger deficits. We'll see more tax-related strategies and interest rate-related strategies and regulatory strategies. They'll do all this stuff. I just don't think any of them will work. And the debate of a year or 2 or 3 years from now will be, well, okay, if all of those things don't work anymore, what's left? And the conclusion will be nothing, and then everybody heads for the exit. And the exit is going to be very small relative to the amount of capital that's trying to get through. So you don't want to be one of the people doing that. You want to set yourself up ahead of time on the other side of that exit, which hence the gold story, because that's where you go, to be away from the stampede when the financial markets realize that financial assets are not the place to be anymore. You want to be on the other side of the door while they're all trying to get through the door.
We'll have more with John Rubino right after the break.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with John Rubino. John, how favorable is the operating environment for gold miners?
This is a good time for gold miners. Basically, what's happening is their costs, which are mainly labor and fossil fuels, in other words, oil to run their earth-moving machinery. Those things, labor's not getting more expensive. Oil is actually getting a little less expensive lately, so their costs are flat to slightly down, while their revenues per ounce of metal that they pull out of the ground is up nicely in the last few years. It was as low as, $1,200 an ounce, U.S., just a couple of years ago. Now it's $1,900. And all of that difference, all of that $700 extra dollars is basically just free money for the miners. So their profit margins are widening dramatically. And a lot of them are generating large amounts of free cash flow. So the question then becomes, well, first of all, that's great for their stocks because that kind of earnings momentum is really attractive to a lot of investors. If Newmont Mining sees its earnings go up by 70% and raises its dividend by 50% this year, then all of a sudden that catches the attention of a lot of people who don't really know anything or care much about gold mining as a business, but they see the companies generating these positive numbers, and they pile in. That pushes the share price of the gold miners up. So gold miners have a rising share price and rising cash flow. Historically, when that happens, they look around for ways to get bigger, and they start buying each other out. So we're going to see a lot of M&A, mergers and acquisitions, in the sector, in the mining sector going forward, which means you want to be owning, well, you can basically own anything and do well in a sector that's got this profile. But with some of your capital, if you're in this market at all, you want to be in the junior miners that are takeover candidates. And one way to find them is to basically just Google that. Junior gold miner takeover candidate, and you'll find all these articles out there of people who are speculating about who's liable to be bought out. So that'll give you some names. And then you should subscribe to a high-quality junior mining newsletter to see what an expert like Jay Taylor or one of his peers think about who's the big takeover candidates in the market right now. Go ahead.
Are those the categories of gold mining stocks that make the most sense right now?
Well, the big ones are the big brand names. If you go to your stockbroker and say, I want a gold miner, they'll put you in a handful of big names, right, that they've heard of. Then there are the mid-tiers who are, they're real, but they're smaller than the big guys, and they're producing and they're making money, and they're very attractive too. And then there are the juniors who are either just bringing a mine online and producing very little, but with the prospect of producing a lot in the future, or aren't even producing yet, but have found a really interesting property that looks like it has a lot of gold or silver in it. Those guys tend to be kind of lottery tickets, which mostly don't work out, but the ones that do work out will go up 1,000%, 5,000%, 10,000%. And we're heading into a time when they're going to behave really well because some of them are going to be bought out, and everybody else is going to start looking around for who's next. And so anything that looks like a junior miner, we'll see capital flowing into it pretty soon. It's not a permanent state of affairs, but there's a couple of really good years for the juniors in the typical precious metals bull market. And I think we're heading into that time. We may not quite be there yet. It could be that the big guys still outperform for a little while longer, but the time is coming when the juniors are just going to rock it. So you should be paying attention to those and deciding what you want to buy at a minimum, and maybe nibbling at a few right now.
John, thank you so much for chatting with us.
Sure thing, Jim. Enjoyed it.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. If you have any questions for John or any of our other guests, you can send them to info@howstreet.com Our YouTube channel is Talk Digital Network. Find us on Twitter at House Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.